And in today's tutorial, it's going to be a continuation of the course ENT202. We have been talking about introduction to entrepreneurship, entrepreneurial ventures, and today we're going to be talking about non-corporate businesses, maybe businesses. But we're going to be seeing the difference between these non-corporate businesses as to what extent they are legally acknowledged, to what extent are their decisions, to what extent are the profit they can make, to what extent are the expansion they can witness. With this being said, let's go straight into it. All right, so we have ENT, something is missing. Just a moment. I think I forgot to use my other light. Plug it right away. Yeah, and we are good to go. So we have the non-corporate business as ENT202. The non-corporate business. Now, all right, corporate business. When we say non-corporate business, what are we talking about? These are the types of business organizations that is formed without any formal authority from an existing government. All right, basically they are not legally, all right, like they need no legal go ahead or legal backing to be formed. All right, it's any kind of business organization that is formed without any form of authority from an existing government. Any boss organization formed without, all right, without any form of authority, all right, without any formal authority from an existing, all right, from an existing government. All right, permit my abbreviations. It's one thing you just have to learn, especially when you're taking notes. You have to, I believe it's one thing you've learned already in GST 101 in your 100 level first semester. When you are in the lecture, when you are taking lectures, you don't make notes. You take notes. So, and one of the characteristics of note taking is the use of abbreviations. So, permit me to do this. Now, it may be registered with the corporate affairs, all right? Be that as it may, non-corporate businesses, organizations can as well be registered under the Corporate Affairs Commission, as a CAC, or relevant authority, all right? They're saying that there is no need for a formal authorities that you can start. All right, as a sole proprietor, you can start a business based on what you think, your intuition, or your research. All right, start a business and you can take it up to the level of registering the business under CAC. All right, but you do not need a permit, you don't need any formal authority or permission from the House of Representative or House of Legislature or the legislators or a formal or an existing government before you can start your business, right? But you can register it under CAC, all right? So now we have a corporate business includes the likes of sole proprietorship, all right? I beg your pardon. A non-corporate business include the likes of sole proprietorship. We have sole proprietorship, and we have sole proprietorship and partnership. Now, sole proprietorship, as we all know, it's not new, all right? It's something we all have an idea about. Sole proprietorship is otherwise known as one man business. All right, one man, otherwise known as one man business. Okay, please, if you're on the stream and you're new on this stream, all right, please do well to subscribe to the channel, and also do well to use the comment section by saying hello, all right, or something, so we can acknowledge your presence. All right, so now, thank you. Somebody smash the like button already. Now, it is a type of business that is formed and owned by one man, all right, and members of his immediate family. One man business, type of business owned and controlled by an individual, all right, or by his immediate family. However, the owner of this form of business is required, like I said, registered to register the business name with the Ministry of Commerce and the business premises within the local government authority in which the territory of the business is conducted. What we are saying here in essence is that you don't need government approval to start your business, but the moment you start that business, note that to get to a point, you need to do some certain registration. All right, it could be locally, all right, in that society or community. You see tax force, you see these people coming here and there, and you might be required to do some certain registration, join some certain societies, communities, just to ensure the smooth running of your business. All right, so now sole proprietorship is the most common form. Okay, I think I'm going to write that here. Excuse me. So let me write, so SP, that's sole proprietorship, the most common what? Form of business practice all over the world. The most common form of business practice all over the world. All right, the reason why people may like to operate sole proprietorship are, why is it the most, have you ever asked yourself that question? Why is it the most common business practice all over the world? Now let's find out why this business is very common. Okay, now some of the reasons are, now we have psychological satisfaction of one's own boss. All right, that psychological satisfaction you get from being a boss of yourself. You don't get to be bossed around. You don't get to say yes sir, yes sir. So it's just psychological satisfaction that, wow, I have a business of my own and the business is thriving. All right, that is one of the reasons why a lot of persons, all right, ventures into sole proprietorship. All right, we have psychological satisfaction. Psychological satisfaction. All right, the feeling of that satisfaction that comes from you being your own boss. All right, we have decision making, fast decision making. All right, it's a one-man business, fast decision making. All right, you make your decisions very fast, and privacy and secrecy of the business. The business is very private because everything that has to do with business starts and ends with the owner. It is the individual that starts the business. All right, he is not required to do what? To publish. It's not required by the law to publish. All right, is accounting. All right, is statement of account. Or now it says here, business are not required. This kind of business are not required by law to publish at the end of the accounting year. All right, they are not required by the law to publish their record. So it's very, that's private, privacy and secrecy. privacy and secrecy. Okay, and we have owner's personal interest, the interest of the business and the owner, all right, manager is the same. Is the person that owns the business is also the same person as the manager, right? So there's nothing like conflict of interest, all right? So there's that. There's also no double taxation, right? It's the owner that is the business. Unlike the entity concept in accounting that is said that the difference is supposed to be separate, right? So if the business is paying tax, the owner is paying tax because it's an entity, it's a concept in accounting. When a business is treated as an entity separate from the owner, all right? But in sole proprietorship, it doesn't work that way. The owner is, all right, there's nothing like double taxation. Okay, so we have the owner, all right, bears all the profit and also bears all the loss, all right? The fact that you do not have to share your profit with anybody is also one good feeling for becoming a sole proprietor. Now, this form of business also has its own evils, all right? This form of business also has its shortcomings, all right? So let's quickly check some of the shortcomings. So we have some of the shortcomings, all right? We have there is a limit to growth and expansion. So we have limited growth and expansion. Limited growth and expansion. All right. There is also, it's just one man. Is limited. All right. It has some serious limitation when it comes to expanding its business because of it might not have the required resources. Okay. So we also have the sole proprietor may not have appropriate skill. All right. It might lack the technical know-how. All right. Lack of technical know-how because he's the jack of all trade. He does everything. He's a financial accountant, he's the auditor, the manager, the sales rep, the marketer, the promoter. He can't have all that skills. All right, so that's one of the disadvantages. Jack of all trade, definitely he will lack some expertise in certain areas and it will tell on the performance of the business. Also, he lacks lack of perpetual existence, meaning that if he dies, the business might die alongside him. All right, lack of accurate stock taking, definitely he will not be accurate when it comes to figures. And also the principle of separate entity is non-existent. All right, there's always room for drawings. Like I said the other time, principle of the principle of separate entity, meaning that as the owner of the business, you don't have any right to just go there and say you want to withdraw money. The business does not know you because the business is on its own, you're on your own. But here, you can withdraw money anyhow. If you make money, if you are not careful or determined enough, you withdraw, you spend money. Money is supposed to be invested back into the business, you spend it because you are the owner, you are the CEO, the manager, the accountant, the everything. So that's what it says here. It says there is always room for drawings. So we have drawings. You borrow money from the business anyhow, and you might fail. So you might fail to return the money. All right. So we have that on sole proprietorship. Now let's talk about partnership. All right. Partnership. According to partnership, okay, persons carried out on a business, all right, in common with the view of profit. Are we together? It is seen as the according to the Partnership English Partnership Act of 1890, English Partnership Act of 1890, all right, it is the relationship which subsists, all right, relationship, all right, which subsists between two parties, all right, and these two parties have the intention of carrying out a business, all right, to make profit, nothing more, nothing less, all right. It says here, between persons or people carrying out on a business in common with the view of making profit. Two people, minimum of two people doing business with the intention of making profit. All right. So now, it is a form of business a form of business. It is a form of business. All right. It is a form of business owned, all right, by a minimum of two, all right, and a maximum of 20%. Owned by a minimum of two and a maximum, a max of 20%. Okay, a minimum of two and a maximum of 20%. In actual sense, partnership business exists as one weapon, right? Exists as the weapon business investors could use to overcome some problems of sole proprietorship. So it's like a combination of sole proprietors, all right, but this one is scared of standing alone, that one is scared of standing alone, and they have almost the same thing in mind, come together, they rub, all right, they rub mind together on certain things and they agree to move on, all right. So it's as one way of opting out of the fear of starting a sole proprietorship business, which is not bad, all right, which is not bad. So we have partnership, like sole proprietorship is not subject to any government authority. Also, just like sole proprietorship is not subject to any government authority, so is partnership not also subject to any government authority. All right. And the formation of partnership here, anything that has to do with people now, there must be an agreement. All right. Anything that has to do with more than one person, that's already involving parties, there must be an agreement. All right. And speaking of this agreement, it could be, all right, let me put that down. Formation all right, there must be an agreement, all right, and this agreement could be oral, all right, it could be oral, it could be written, all right, it could be oral, it could be written, or it could be implied, all right, but in most cases it is advisable that any agreement between any agreement between individuals to pool their resources together to form a business, it is best written, all right, and not oral or implied. written in the sense that when it is written in black and white, all right, it is enough evidence, it is enough proof that okay, so date, so day, so time, Mr. A, Mr. B agreed to start a business. All right, according to Mr. A and Mr. B, they named this business so and so. When it comes to sharing of profit, this person gets 5%, this person gets 5%, or maybe Mr. A's capital is much, so he gets more interest than Mr. B. Everything will be written in black and white, so that if there happens to be a situation whereby they are not making so much money, so much profit, nobody will, all right, misunderstand the other person, because everything has been written in black and white. Nothing is hidden. Okay, so for this purpose, note that it is better that the agreement is written and not oral or implied. Please note that. Now, the agreement is called partnership deed. All right, this agreement between partners is referred to as partnership deed. Now, let's take that down. To as partnership deed. All right, so now it is this partnership deed, all right, that is seen as a legal agreement. Okay, this partnership deed is seen as a legal agreement and not a requirement, and it specifies the rights, power, interest of the members in a partnership. All right, so the most difficult part of this business is not the execution of the business itself, but it is the execution of the deed. All right, because it has to be specified. Definitely it will grow. All right, because it is said that one head, two heads are better than one head. The business will grow. All right, so for it could even, the business could grow than it could grow and outlive its founders. You have businesses like that the founders are long gone and the businesses are still doing well. All right, so the partnership deed has a lot of things to sort out. So even when the business outlives the founders, the deed will be there to guide anyone. Maybe the next of kin of Mr. A is Mr. C, and the next of kin of Mr. B is Mr. D. So when he's coming in to take over his father's business, and when Mr. C is also coming in to take over, everybody knows their right from their left, and nobody is crossing boundaries. So we have that as that. And very quickly, we'll look at the types of partnership, and we'll call it a wrap for today. So permit me to erase the board. Okay. Okay, types of partnership. Very quickly before we call it a wrap for tonight. So when we say partnership, what are the types of partnerships? All right, the types of partnerships. Okay. Okay, so we have the ordinary, partnership. We have the limited. All right, we have the limited partnership, the ordinary partnership. We have the industrial partnership, and we have the joint venture. All right, these are the various types of partnership, and I hope that we'll be able to dissect some of them. All right, we have the ordinary partnership, and we have the limited partnership, we have the industrial, all right, industrial partnership, and also we have the joint venture, all right, joint venture. Okay. So let's see if we can take some of this because our time is fast spent. Now, ordinary partnership, this is a kind of partnership or a kind of partnership business where the liability of members is, all right, not restricted to their investment. All right, liability of the member is not restricted. Okay, when we say liability is not restricted, this is what it means, because you'll get to hear this a lot as we comment. When it comes to loss or damages, everybody will have a role to play in it. All right, that's what is called unlimited liability. But when we say limited liability, when it comes to loss or damages, what will be affected will be just your contribution to that business, your investment, your capital, your assets, what have you, that you have invested in that business. All right, so differentiate it now: limited and unlimited. Meaning that if the businesses crash and you guys have borrowed money from the bank has the right to collect your car, collect your house, collect any of your belongings to clear your debt. That is the unlimited. But the limited has to do with the only thing you are losing is the money you have invested in the business. Nothing more, nothing less. So now for the ordinary partnership, for number one, for the ordinary partnership, this partnership business is where the liability of the member, all right, is not restricted to their investment, meaning that it is unlimited. Now, members of ordinary partnership are, so let's take that as ordinary partnership members, OPM, ordinary partnership members. All right, we have general or ordinary partner. Okay, general or ordinary partner, this is the partner who has an invested capital in the business and participates actively in running the affairs. All right, invested capital, all right, and also an active member. When I say active member, he is, when it comes to making of decision, when it comes to going and coming in and going out transactions, is an active member. He knows the in total, all right, anything going on in the business is aware of it. All right, so that's general or the ordinary partner. All right, is a partner who has an invested capital in the business and he participates, all right, actively in the running the affairs of the business. Now we have that's for the general or ordinary partner. So we have for the sleeping partner, all right, like the name says, sleeping or dormant partner. All right, like the name says, this is a partner who does not take part in the management of the business, but he has an invested capital. Okay, the sleeping of the dormant partner does not, maybe he has some other engagements, so he does not have time to be, all right, to put his effort, or is always aware of whatever is going on. Okay, but when it comes to contribution, he will contribute, all right, but he's not active in the running of the business. All right, so let's put it as not active but has an invested capital. All right, not active but has an invested capital. Then we have the nominal, so as we have the quasi. All right, I think we'll stop with this two for tonight. Then the nominal is this kind of partner who has no invested capital and is not involved in the management, all right, of the business, but lends is, all right, his name to be used. Now let's say, for example, we want to start an NGO. No, NGO is some. Let's not use NGO. We want to start a bank, all right, as a group. We want to start a bank. So now we want to use somebody's name that is well known in the country. So we can use maybe one of the ex-presidents, or maybe one of the very successful banker in the country. He's not a member of the business, but definitely he will get some things from some returns, because if anything goes wrong, it will still tarnish his image, and if it goes right, it's like, okay, thank God. People will be like, okay, we so far they even have this man in this business, involved in this business. There's nothing to doubt. It's already a success. All right. This is the kind of partner. This is the nominal partner. He doesn't contribute, he doesn't participate, but he allows his name to be used as a goodwill to running of the business. So anywhere you go to, you just an ambassador. Our ambassador is a former president. They'll be like, wow. So he has a hand in this business. That's like already a pass mark already. All right. So that's for the nominal partner, and for the quasi partner. All right. I might not be able to take much point on that, but let's just nominal, not active. All right. Not involved, no capital, but goodwill. All right. Then we have the quasi. Then what is the quasi? The quasi partner is the partner who had retired from the partnership, leaving his capital in the business as loan. All right. He is no longer a member or a partner. He has retired, but he left his capital as loan. All right. And definitely he will get something in return. So we have retired partner, all right, left his capital as loan. So if his money has not been paid, all right, that is, if he doesn't want to take all his money, all right, if he wants to take all his money, they can give him his money and they can pay him off, in as much as the business has stand, that if you remove his money, his investment, it will not affect the business. But if removing his investment will affect the business, he's not going to get his money, all right, but he will be paid like a pension or something gradually until the agreement is complete. All right. So I think on these notes we will call it a wrap for today, and in our next class we should also be dissecting some of the other partnership, like the limited and some of them that we made mention of. So thank you very much, everyone. Have a wonderful evening, and I look forward to seeing you all in subsequent tutorial. Bye bye.